Are mutual funds more efficient than PMS? This question has been raised and addressed in a recent media article with a lot of arguments in support of mutual funds. Now, when we generalize, we commit a judgmental bias into our opinion. What is the judgmental bias? The judgmental bias is that in this market, if you are managing a portfolio, you need to create high churn. Fundamentally, I disagree with this premise, because if you are going to make your returns only by trading and high churn, whether it is in a mutual fund or in a PMS, you are committing the investor to a higher risk profile, to a higher level of risk in his portfolio, and to a higher incidence of taxation in his portfolio. Where the argument for mutual funds seems to be at an advantage is that mutual funds don't pay tax on trading. But I believe that the behavioral consequences, the tax for overaction, excessive trading, is probably higher than the capital gains tax in our country. I think overlooking that aspect and kind of brushing it aside is not a well-reasoned investment judgment. That is where I think that mutual funds are at a risk when compared to a PMS which doesn't trade much. Again, not trading is not a virtue. Let me tell you that. If you are holding the wrong stocks, for example, there has been a hypothesis that you can buy at any price and hold. Assume that you are having a PMS portfolio of expensive stocks and you are continuing to hold it. If the macro scenario remains what it is or even becomes a little tighter, then valuations are bound to contract. And the fact that you have made your valuations at entry point very, very high is going to work against you. So, just holding those stocks continuously may not help. You may actually need to exit those stocks now. So, what kind of a portfolio you have constructed? What is the valuation construct of your portfolio? How is the growth construct and the valuation construct, getting reconciled? These are factors which are more important than a generic judgment of taxation and trading. You need to not only buy companies which you don't trade too much, but you also need to buy companies which are going to give you a better return and a better reward for holding them for a long duration of time. So, it's far more complex than this simple generalization. But one thing is certain. I believe that mutual funds is any day better than an individual investor going on a platform and slowly getting sucked into personal trading and then getting drawn into option trading and then landing in a cesspool where he is going to permanently lose his capital. Over that, any day I think mutual fund is a better option. Within mutual funds, I would qualify and say that taxation benefits apart, I would any day prefer an investor to go to a mutual fund where the trading is kept in check and there is no urge to trade just to improve the NAV. Where funds overtrade, I am of the view that it is going to come to hurt someday, no matter what the rate of taxation. Even if it is zero, you are going to be affected, because one cannot control his investment behavior sustainably to deliver benefits to himself or others if he is going to overtrade. And that is what I think will differentiate a product, whether it's a mutual fund or a PMS or an AIF, whatever you're buying. You must have a fund manager, investment manager who is responsible and controls a product in such a way that he does not take you, the investor, to a higher plane of risk in order to generate higher returns. And if he is able to generate your desired returns or your targeted returns or something higher than that by keeping your risk lower, then that product should be your preferred product in whatever space it may be. So, in that sense, my judgment on this issue is more nuanced and subtle, because investments is about understanding these subtleties clearly and implementing your decisions with a good awareness of what this understanding will lead you to. Hopefully, this understanding leads you to a better place. Thank you.